Hey Bowtie Nation, Joseph Hogue here with a great dive into something most investors just never think about, seasonal trends in the market and what it means for your investing strategy. For example, not only are there specific months where average returns are higher, but even specific days. Over the last 50 years, if you had bought stocks the day before the Labor Day holiday and then held the rest of the year, you would have booked a 33% annual return. And that's not even the highest of the days that we'll look at. I'll turn it over to our resident stock trading expert, Thomas Carvo, to explain how market seasonality trends work, what it says about when to buy stocks, and how to invest.
What's going on, everyone? Hope you're having a great day. So it's never really a bad time to be buying stocks, especially if you're buying quality companies, you're buying index funds or ETFs that you plan to build out large positions, dollar cost average into for the long term. But what if I told you that there actually were specific times of the year that you could potentially time your buy-ins and that they will result in higher returns over the long run? That's what we're going to talk about here in today's video. And no, we're not talking about technical analysis. We're not diving super deep into indicators and all these different things that can complicate looking at charts, can complicate your trading or investing. Please, we're not talking about that. But if you did want to dive deeper into that, there's a webinar linked down below where Joseph and I cover 3 trading signals that you can add to your arsenals, and we'll have more on that here at the end. But what we are going to talk about is seasonality. We're going to talk about the times of the year that historically prove to be good buying opportunities in the stock market. Then on top of that, we're going to take it a step further. We're going to dive into specific days of the year, actually targeted around holidays, around stock market holidays, that we see a substantial difference in returns the past 50 years. So let's dive right on in. The chart we're looking at right now is the S&P 500 average return by month. Now, what you'll see here is that there's really 3 notable months. There's June, which you really don't see much. It's pretty much flat over this time span from 1964 to 2015. We're going to talk about the past 20 years specifically in just one second. And then we see August is slightly red and September tends to be substantially more red. And those are the 2 months out of the year that we do see the most weakness in the stock market going back right into this span of time. But then we see that followed up by 3, actually 4 very strong months in a row that average over 1% returns. October, November, December, and then even into January. So just looking at this chart, what does it tell you? Well, if you see dip opportunities and you see the stock market pulling back in the months of August and September, it tells you that if you had some extra cash sitting on the sidelines that you wanted to build out or wanted to add into longer term positions, that would be the time to deploy that capital. This document from Equity Clock kind of shows something similar, but it kind of takes you by different indexes and different sectors, and we're going to talk about that. So what you'll notice here is that these bars across this timeline, that just indicates the strength or that relative strength for each index or sector or whatever you're looking at, okay? So you'll notice that the right-hand side here of this top graphic, the S&P, the Russell, the NASDAQ, that August-September window, we don't see any bars there. We don't see any relative strength there. You see that actually the volatility index, the VIX, from July 3rd to October 9th, that's where you see the relative strength there, overlapping with when we see seasonal weakness across the S&P. We see Treasury bonds strong during that time as well. And then the dollar has its strength really towards the beginning of the year, the first 3 months or so of the year. Now, looking into sectors, what you'll note here is that during those weak times of the year, what do you see do the best? We actually see energy stocks tend to be a little bit stronger during a weak time across the S&P. We see consumer staples, we see healthcare, and then we also see utilities performing quite strong during a seasonally weak period of time for the S&P, for the Russell, and even the NASDAQ. This chart will now take into account the past 50 years. So it's a slightly different take on that bar chart we looked at a few minutes ago. And we always talk about that 8 to 10%, 12% target rate per year in terms of what you're going to see on average across the S&P in terms of percentage gains. And we end up right up around that 9% on average over the past 20 years. So really from like 2001 through the end of 2021, here's the data that we have. You'll note that August-September timeframe actually tends to be quite strong over the past 20 years. But the back half of September, we tend to see pullbacks into the first half of October. Then from the first half of October, if you see pullbacks, the market, what we've seen based on the past 20 years, that quickly gets bought up and we see relative strength into the end of the year, almost doubling or pretty much doubling market returns from that October, mid-October timeframe into the end of the year, which is quite notable because you're only up to about 4.5% by October. And then from October to year end, you make your way up to 9%, which is pretty strong. You'll also see that the second half of June tends to provide dip opportunities. And the first few months of the year, first 3 months of the year, actually, we see a lot more choppiness and a lot less direction across the overall market. Take it a step further. Now let's talk about individual days. It's very difficult to time the stock market, and there's always a different situation. Every year is always different, right? But this chart right here is going to take us back over the past 50 years. And on the left-hand side, we see the holidays, okay? So here are some of the larger stock market holidays that we have a lot of data on over the past 50 years and performance indicators into year end. So the first column right here is if you buy 2 days before the holiday and then sell at year end, here are your returns. Notably, pretty strong across certain holidays, but we do have some holidays where we see red. And if you were to look at buying 1 day before and selling year end, here is where things get kind of crazy. The returns are exceptionally strong. Every single day, every single holiday, we have positive returns into year end. Every single one. So why is this the case? Well, going into holidays, you actually see a lot of people, a lot of investors and traders, they tend to try to trim out of positions. Why? Because of the unknowns. Because they're going into a holiday, it provides an extra day or two for news to come out that could drive stocks down, that could be bad for the overall economy, that could be bad for the stock market, and they want to limit their risk and have less exposure potentially over these holidays and over the weekends. And that's why we see these numbers, and that's why we see some selling pressure in advance of these holidays. So seeing that weakness and taking advantage of that weakness by buying 1 day before the holidays and selling towards year end, the returns are quite exceptional. However, does this mean that you should just follow this chart? No. The best way I see this, or the best way to utilize this, is to take it with a grain of salt, but then apply it to what you're seeing day to day, week to week, month to month, year to year in your own trading. Now, if you were to see weakness a day or so before these holidays, that could be an opportunity to look to dollar cost average. If you've got some cash sitting on the sidelines that you wanted to deploy anyway, this could be the opportunity or the time to do so. Now, what's notable here when it comes to these percentage returns and what's useful is that if you were to just simply add in and not sell at the end of the year, because that's not realistic for all of us. We all want to hold our positions. We don't want to have short-term capital gains. We want to have long-term capital gains, which we're taxed at a lower rate. And if that holds up going forward, it could be really beneficial to dollar cost average on these dates, which can help compound our returns over time versus blindly buying and selling or blindly buying stocks during times when you have no idea, but you set up an auto deposit or an auto buy during times where you don't have any data to back up that buy. You're only just basing off of knowing that, hey, the stock market goes up over the long term and I'm buying stocks and companies that I believe will grow over the long term. And so if that's your strategy, that's awesome. That's a great start. But this could be that icing on the cake to help improve those returns and compound at a faster rate over the long term. And that is what the biggest takeaway is here from this video. So if you want to dive deeper and you want to look a little bit beyond this and you want to talk technicals, you want to talk indicators and trading signals, there will be a webinar linked down below that Joseph and I put together covering those 3 trading signals that you can add to your arsenal, your investing, your own trading that can help compound those returns. And hey, a little bit better this year, next year, the year after that. Just think about that. A little bit goes a long way over the lifetime of your trading and investing career. And that is what we want you guys to take away from this video. Thanks so much for watching. Make sure you are subscribed, join the community, hit that thumbs up button if you got some value out of the video, and we'll see you guys in the next one. Have a great day.